What is a credit crunch? A credit crunch occurs when the general availability of credit declines considerably. We also use the term when it suddenly becomes harder to get a bank loan. The decline in the availability of credit occurs regardless of interest rates. In other words, the difficulty in getting a loan increases whether interest rates rise, fall, or stay the same. We also call it a credit crisis or credit squeeze. Banks and other creditors become reluctant to lend money during a credit crunch. Both private individuals and companies notice the change. Banks are more apprehensive regarding lending because there is a greater risk of default during a credit crisis. This is due to either political problems or adverse economic conditions. During a credit squeeze, lenders become much more selective about who they lend to. Their focus shifts from quantity to quality. During a credit crunch, lower income and middle class households, plus SMEs, suffer significantly. Ironically, during a credit crunch, those that continue finding it easy to borrow don't need loans. To counter the risk of defaults and bankruptcies, central banks reduce interest rates to stimulate money markets. A credit crunch can significantly prolong an economic recession. It might also slow down a recovery. This occurred in the 1930s during the Great Depression. During that time, the US Federal Reserve reduced the money supply after the 1929 Wall Street crash. It refused to liquefy markets and thus triggered deflation. A depression is a severe economic downturn that continues for over 3 years. Thank you for watching this brief video on what is a credit crunch.